Julie called me up to help put together this session today on the 2021 economic outlook. And I was so pleased to get a hold of Jim Allen, who's also bringing on board Jason Trennert. And I'm going to do an intro of both of these individuals. Jim is really somebody that doesn't need an introduction. Jim, I think I met 25 years ago when he was leading some community cause. Jim has been chair of the board of just about every major public organization in our community. He has received just about every award that you can get in our community. He is, when you think of a great community citizen, it is Jim Allen. Some things you may not know about Jim. Jim has spent his entire working career with Hilliard Lyons, and he served as CEO of Hilliard Lyons from 2004 to 2019 when it merged with Baird. And he is currently serving as vice chairman of Baird, and he's on the executive committee out of Louisville. He's playing a very major role in the financial industry. I learned, I was embarrassed to not know this until I talked to him a couple weeks ago. Last year, Jim served as chairman of the Board of Securities and Investment and Financial Markets Association. It's known as SIFMA. It is one of the premier financial industry organizations. It would be the equivalent to being chair of the National Bar. And he was chair of the Securities Industry and Financial Markets Association. It's a great honor to have someone like Jim Allen from Louisville, Kentucky, representing Louisville on the national stage is unbelievable. He's now serving on the foundation, and the foundation of SIFMA is doing a lot of economic education and financial literacy. And hopefully Jim will have a chance to do a plug on that because they're doing great things. A couple other items about Jim. He's the immediate past board chairman of Jefferson County Public Education Foundation. And he's really big in education. He serves on the advisory board for the business school at the University of Louisville, board of trustees at Bellarmine. And of course, he loves when he hears this. He serves on the Dean's Advisory Council for Fisher College of Business at the Ohio State University. So Jim, we're looking very forward to having your comments. I also want to introduce Jason Trennert. So in my research about Jason, if you Google Jason, you will be amazed by the accolades that he has and what a leader he is in the financial industry. He is on CNBC, Fox Business News. You go out there, you can find a ton of YouTube programs about him giving comments about the financial industry. Mr. Trennert is chairman and chief executive officer of Strategis and its related companies. He started about 5 years ago with 5 employees. Now he's got over 50 employees. They're in New York, Washington, D.C., and Columbus, Ohio. He is such an accomplished person. He is sought after by many, many strategy and financial individuals as they try to determine where financial markets are going to go. He is acclaimed on the national stage. It's going to be very interesting to see what he has to say. In 2013, he really coined the TINA effect, which is there is no alternative as it relates to equities in the world of perpetually low interest rates. And he was early recognizer of what Donald Trump would mean to the financial markets. And he has been interviewed time after time of the Trump effect upon the markets, both good, bad, and ugly. So I'm really looking forward to seeing what he has to say in his presentation about what we should examine in 2021 from an economic perspective. With that, Jim, I'll turn it over to you.
Great. Thank you, Lewis. And thank you to the Downtown Rotary for inviting us today. It's really a privilege to be here. And you're in for a real treat with Jason, as Lewis acknowledged. Just by way of a little bit of background, the Strategis organization is part of the Baird organization, just like Hilliard Lyons. They just happened to get there about 18 months before Hilliard. So Jason and I have the opportunity to connect as part of the Baird Executive Committee. I've gotten to know him. And I think like I said, you're in for a real treat, not only with the content of what he has to deliver, but the way in which he delivers it. Just so everyone is aware that Strategis is a big picture macroeconomic organization, and in fact has been acknowledged as #1 on Wall Street for 4 years in a row in that space. So obviously an organization with tremendous resources and capabilities. Jason was the founder, chairman, and CEO. And what we're planning to do today is for Jason to make some opening remarks, and then we've got Q&A that we have assembled, or Q that we've assembled from all of your members, and then we will respond with answers to those, or I should say Jason will. I'll conduct that Q&A session. So with that, Jason, I'm going to kick it over to you, and then we will come back with some questions here in a little bit. Again, thanks for having us.
Well, terrific. Thanks, Jim, and thanks, Louis. And given those kind introductions, let me just say, before I say anything, let me just manage your expectations about forecasting, kind of the unforecastable. I always start. Jim's heard me give this talk a few times, but I always give two kind of disclaimers at the start of these discussions, and the first disclaimer is that John Kenneth Galbraith once said there's two types of economists: those that don't know, and those that don't know they don't know. And I am very much in the realm of I know I don't know, and that greatly reduces the chances of me making an error, because there's a lot of humility in the way we approach looking at the economy and the way we approach looking at the financial markets. The second disclaimer is that we're going to have to talk a little bit about politics here, and I don't want to offend anyone's politics. I'm just, my job is to try to get to the right answer, likely what's going to happen, as opposed to necessarily what I want to have happen. And so I'm perfectly fine if you send me hate mail or something, but I'm just letting you know, it could happen. It's possibility. So what I'm going to do here for about 15 or no more than 20 minutes, because I know you guys are on a tight schedule. I'm just going to show you some slides and try to show you some things you might not know, and then also try to draw bright lines between my opinions and facts, because obviously there's a lot of discussion about about that today. But let's see if I can do this here. And hold on one second. If I can, there we go. Hopefully you guys all see that. All right, so are we seeing the right thing as opposed to my calendar? You guys seeing that? So here's the this is just the title play. It's investing in the COVID era. The ultimate broken play. And just like in football. I think there are a lot of well laid plans, and once the ball snaps, you never quite know what's going to happen. And COVID certainly, I think, qualifies as that. I've spent 30 years professionally studying economics, or 30 years as a practitioner. Before that, I was in school.
Jason,
yep.
We're seeing a different screen. I think you've got your PowerPoint's not showing.
What am I showing you?
You're showing what looks like a Bloomberg. There you go.
Here we go.
There you go.
Okay.
You got it.
There we go. Okay, so good. Thank you for that, Jim. All right, so here's I'm going to be looking a little bit away here, so I apologize for that. But broken play. I think one of the questions, here's a bullet point base case. I'll pick up the pace here about what we're thinking. My own opinion, again, I'll show you facts and opinions. My opinion, just to start out with, is simply to say that I think in some ways the black swan, what we call the black swan in economics or in the financial markets, which is the unexpected event that changes everything. I do think economic historians, financial historians are going to talk a lot about whether the black swan was the virus, or whether it was our response to the virus, whether it was the lockdown. And I think over time, it's very hard to do that now. I know emotions are running quite high, and there's been a lot of pain associated with the virus. But economics is largely the study of trade-offs, of not always great trade-offs either. And I think there's going to be a lot of discussion about that in the future. That's just my own opinion. Another thing I would show you here, and one of the questions we get a lot from people, both that are in the investment business and those who aren't in the investment business, is say, how do I square the fact that there's 10 million fewer people in the workforce with the fact that the stock market is at an all-time high. How do I square those two things together? And as I'm showing you here on the bottom of page 2, this is really just the difference between the U.S. economy and the S&P 500, right? The main index that we use as professionals to determine how the market's doing. Quite simply, the S&P 500 is made up of 11 sectors, and 27% of the index is made up of just the technology sector itself. And then if you were to add healthcare, you'd be add another 14. You'd add communications, that might be another 10. Financials might be another 10. So I guess the point is you could get to something like 60% of the stock market without dealing a lot with the consumer. Whereas if you go into the U.S. economy, if you remember maybe from your economics textbooks, GDP is made up of consumer spending plus capital spending plus government spending plus net exports, right? And about 70% of it is made up of consumer spending. So quite simply, the biggest differences between the economy and the market is that the economy is much more consumer spending based and the S&P 500 is much more capital spending based. The U.S. economy is somewhat more domestic, and the S&P 500, about 40% of its profits are derived from outside the U.S. So that's part of the reason why it seems like the two things they should be almost precisely overlapping, but they're really measuring two very different things. And I've told Jim before, I'm going to make this presentation available to all of you, so mercifully you don't have to read this small type here. Our best guess, is that GDP growth is going to be very strong this year. It's going to come back in a very big way. Probably going to have something in the order of 6% real GDP and maybe another 1.5% to 2% in inflation. So something like 8% nominal growth, which is really kind of almost unheard of in the United States, at least probably since the 80s. We haven't seen numbers anything like that since the 80s. But that's largely because of obviously the fact that we're going to be reopening the economy in large measure, but it's also going to be because of, for lack of a better term, I don't make this a loaded term, but the hyperactivity in Washington, D.C. And we are spending money at a rate, the federal government is spending money at a rate that we have not seen really since 1942, since World War II. And for those of you who've been kind of keeping track at home or may have lost track at home, we've spent so far about $3.3 trillion going back to last March. It started out with $8 billion for coronavirus, then we had paid sick leave and unemployment insurance. The CARES Act was the biggie, $1.7 trillion, the payroll protection plan, and then just at the end of President Trump's term, we passed another $900 billion fiscal stimulus package. That's $3.3 trillion. That's a lot of money. Nominal GDP in the U.S. is about $21 trillion. Okay, and then President Biden, he introduced his fiscal stimulus package, his first one. He says this is a down payment of $1.9 trillion. Okay, which is about 18% of GDP. And so I don't know how familiar you all are with these numbers, but these are just kind of out of sight, other universe types of numbers and again, given the coronavirus, I'm not saying it's not worthwhile, but it's eventually the thing that worries you, of course, is that you're going to have to pay this back. And the U.S. has the benefit of being the reserve currency, which allows it to get away with spending a lot of money we don't have for the time being. But I do worry, I have to say, and this is an opinion, this is a fact, what we're spending. And we'll see whether the 1.9 trillion comes to pass. It might be skinnied down over time. President Biden has also talked about another package later this summer, which would be infrastructure. So again, you're talking numbers that are, kind of way beyond what we've seen in a long period of time. And there's nothing wrong with that per se, except that, if this kind of worked on a sustainable basis, there would be no need to have an economy at all. You just have government spend money it doesn't have, and we could all just do whatever we want to do. But the problem, of course, is that sooner or later you got to pay for it. So you have this double-barreled approach. You have this very enormous fiscal policy response, and then you have an enormous monetary policy response. And this is the balance sheet, the size of the balance sheet of the Federal Reserve Board. Okay, and I know there's a lot going on here, but just to give you some idea, before Bear Stearns failed in 2008, the Fed's balance sheet was about $800 billion, and about 90% of it was comprised of the U.S. Treasuries. Right now, after the financial crisis, it swelled to $4 trillion. Okay, and assets for any bank are loans, right? So these are essentially loans that are extending into the market. Right now, after COVID, it's $7 trillion. So in 12 years, you've largely gone, 12, 13 years, you've gone from about 800 billion to 7 trillion. And 90% of it isn't in U.S. Treasuries. So, the Fed is accepting kind of everything short of like used dog toys as collateral right now. So this is very high-powered money. And so this is why I'm so bullish on the economy for this year. And I think, again, this stuff can work. It will work. The question is what the unintended consequences of it will be over time. So that's kind of just a broad overview of the economy. I wanted to show you a few. I wanted to show you a little bit just since we had the inauguration yesterday. I'll go back to valuation in a moment. I remember very specifically having a slide precisely like this when President Trump was inaugurated, 4 years ago. And I had the advantage of knowing personally a lot of the people that were on the economic team in the Trump administration. And so we had a pretty good handle at our shop of kind of knowing what the game plan was. And the game plan under the Trump administration was largely one was cutting corporate taxes, was a very big priority. The second was deregulating the financial industry. A third thing was becoming a net exporter of fossil fuels. And the fourth priority, economic priority, was a big infrastructure program. Those were the four main priorities of the Trump administration. Obviously, this is a very different administration, and I'm getting this directly from President Biden's website and what he was talking about on the campaign. And these are the main priorities, and we've talked about the first one, which is another round of income replacement or fiscal stimulus. The second, of course, is just a very kind of hammer and tong approach to getting rid of this scourge of COVID-19, which is terrific. But the other two that I think is just something to keep in mind that are very much part of these aren't tertiary considerations for the Biden administration, but climate change and addressing income inequality and racial justice are part and parcel of the basic platform of the economic policy of the administration. And the reason why I make that distinction, that is part of it obviously should be part of everyone's platform, but making it be part of the platform of the economic plan, I think is somewhat controversial. My own opinion, so that's a fact, what the economic priorities are. The opinion is that I'm very skeptical personally that, let's say, the Federal Reserve Board can do a lot about climate change. But if you look at the people that President Biden is surrounding himself with, it's very clear on the economics team, climate change is something that weaves through the entire, it's a theme that kind of binds them all together. And so I think that's important just to kind of keep in mind, as we see things unfold and we see these plans come come to fruition. My own opinion is that, and it's not much of an opinion, it's virtually certain that the way the budget works, you're very unlikely for the Biden administration to do this without raising taxes. The way the budget rules are written, once you get beyond a certain level, you can't really do it through reconciliation. You actually have to have things to pay for the programs that you're promoting. And so our opinion as a firm, and we have a very good Washington, D.C. office, is that corporate taxes are likely to go up to 20. We're forecasting 25% from 21%, and we would also see the top marginal income tax rate probably move back to something like 39.6%, or there may be even something more in there. As far as the other taxes are concerned, small business taxes, capital gains, and dividends, estate carryover, I doubt much is going to happen on the estate carryover, but the ones I think are kind of layups, however you think about it, whether it's a good thing or a bad thing, would be an increase in the corporate tax rate and an increase in income taxes. So anyway, that's the Biden economic agenda. In the short term, it's probably not going to make much of a difference just because you're spending so much money. It'll flow through the economy. But again, the bigger question from an economic or from a market perspective is whether it affects the markets, I think, and at what point do the costs of these programs actually impact the overall market. And markets generally tend to be ahead of the economy itself, and this is a big question. This is something where I know there's a lot of talk, probably if you watch CNBC or watch some of these other programs, there's probably a lot of talk about how this is like a bubble, or it seems like the market in certain parts of the market I think are very similar to a bubble. And I would argue, if you look here, these are prior peaks, bull market tops that we've seen, and we look at TTM stands for trailing 12 months, and NTM is next 12 months, and we look at the current PEs, and you look at the average of prior times when you got yourself into trouble, when the market went down, and you can see right now from a PE perspective, the market is expensive. There are no two ways about it. Market is more expensive than it was in March of 2000 on a trailing basis, and it's just a little less expensive than it was on a forward basis than March of 2000, the dot-com bubble. The part of this that's important, and I don't want to lose people here, maybe there's probably a fair amount of you that are thinking about winning the Masters now or something, or thinking about something else, but the way to look at this is to look at it versus the interest rates, and that's what we call the equity risk premium, which is that you look at the earnings yield versus the 10-year Treasury yield. And the point of this page is to largely tell you, with 10-year Treasuries at 1.1%, the stock market isn't that expensive. You can see here the equity risk premium was negative in March of 2000, and we're quite positive right now. So big takeaway from this page is that I'm not particularly worried about valuations right now, unless long-term interest rates really started to rise, and by really start to rise, I mean we get to something like 2.5–3% on the 10-year Treasury yield. It seems to me the market's going to have a lot harder time, and I think the market's going to have a harder time anyway, just because it's just harder to get interest rates much lower than they are now, and it's harder to get the PEs much higher than they are now. So market may do okay, but I think some of the big gains that we saw over the last couple of years are going to be harder to come by. I just want to show you a couple more slides, and then we'll get to Q&A. I think this is an important chart, and simply these are, again, in the things you might not know or might not be focused on. But before we had COVID, there were 153 million people in the workforce in the U.S. or that were working on non-farm payrolls. It fell to 130 million, so we lost remarkably 22.5 million jobs in 2 months. But we've had a pretty, V-shaped, kind of rebound. But of course, a V is a symmetrical shape. So I guess what I would say is this is looking more like a reverse check mark or maybe a square root or something, which is to say we're still 10 million people short from the amount of people that were employed at this time last year. Okay, so there's a long road home for the employment in the labor markets, and some of that will be taken care of course, when kind of hospitality and travel and all those things come back fully online. We're going to soak up some of that 10 million pretty quickly, but it's just by manner of saying, this is a lot of this fiscal stimulus will make the economy look stronger probably than it is, at its very core from a fundamental perspective. One or two other charts here, and again, I want to keep you on time. One of the things I would argue you take a look at if you're interested, if you aren't bored silly by this stuff by now, and you're more interested in looking at other data, there's a website called tracktherecovery.org, and it's a joint venture between Brown and Harvard, and one of the things they do, it's pretty, and it's pretty easy to, pretty accessible, I would say, is they look at income quartiles. They look at all the people in the U.S. and they look at by the amount of money they're making in quartiles. And one of the most fascinating things about this period of time, believe it or not, is that the bottom quartile of wage earners are actually spending more today than they were a year ago. The top quartile, that's what's in red, are actually spending about 5% less. And it's pretty remarkable because obviously the job prospects for the bottom quartile are not as good and all the rest of it, but the bottom line is the fiscal stimulus has more than made up for what people would normally spend on. For the top quartile, frankly, there's just not enough avenues to spend the money. And that's why it seems to me the high end is going to come back in a big way, once this is over, just because, it's just hard to go on vacation or spend money on a business trip or, all of those things as the economy gets back going. I mean, this could flip, I guess is what I'm getting at, when things kind of go the other way. All right, I have 2 more minutes. So I'm going to show you one thing. I would show you this on a market perspective. And I have to say, all of our clients are active managers, so I'm somewhat biased, but I know that it's been very focused on. There's been a big focus on passive investing, or index investing, and the biggest, I would say the biggest problem I have with it now is that there's an awful lot of concentration risk. If you're just buying an S&P 500 index, which Warren Buffett tells you to do, which has been correct, by the way, for a long period of time. It saved you a lot of time and effort for a long time. The only problem with that now is that, believe it or not, 5 stocks make up 20% of that index. That's Facebook, Microsoft, Apple, Amazon, and Google, right? So you're taking a lot of concentration risk by doing what you think might be the prudent thing and putting your bets out over 500 companies. You're really making a big bet on really 5 companies. And that's why my own particular opinion is that it makes sense to go with I think active management, in my opinion, is going to be a much better place to be. The thing I'm going to end on here, and sometimes I write about 2 reports every week, and sometimes you write these things and 3 weeks later you want to forget that you ever wrote it because it's so wrong, and then other times the things age better. And this is something I would argue, this is what I wrote last March and April about what I thought were the long-term winners and losers from the pandemic. And I would say, for the most part, I feel pretty good about them, which is we haven't changed any, we haven't switched sides on any of these items, but you can take a look, at this, but in terms of what the losers are, but I'll leave it at that. I'll let you all look at that when I send you all the handout. But in any event, let me stop there. I hope that was useful, or try to go over a lot of stuff in a short period of time, and I'd be happy to answer any questions, Jim, that the Rotary Club of Louisville has.
Great, thank you, Jason. Very, very insightful as always. And as Jason indicated, the deck will be shared with all of you, so you'll have a chance to take a look at it, and we'll be happy to respond afterwards if you are so inclined to want to ask. So let's start with your commentary or your comments about monetary and fiscal stimulus. How worried are you about inflation in both the short and long run as a result of all of this accommodation?
Yeah, Jim, I have to say, I would say for those of the people, those people on the call, whether it's for their own personal investments or whether it's, they're part of they're on the board of a fiduciary, an endowment, a pension fund or something. I think, frankly, inflation is probably always should be the most important thing you're worrying about. Now we've gotten out of the habit of worrying about it for a long period of time. As you know, long-term interest rates peaked in the early 80s, and inflation has been kind of non-existent for a long period of time. Having said that, Jim, we're doing an experiment here in terms of this double-barreled approach to fiscal and monetary stimulus that makes me think that our chances of sticking the landing on inflation are like 1 in a million. Now, the question is, do you see inflation in the next year or two, or is it something that's longer term? You see it, is it come later on? My own particular feeling is in the shorter term. I think it's likely to be. It's unlikely to see big increases in inflation on a broad-based level this year or next year. But I do think if you're making long-term planning, again, whether you're retired or just you're just on an investment committee, I think you almost have to build in the expectation that inflation is going to be higher. The Fed itself is telling you that it wants higher inflation. And now there have been other central banks around the world, like Bank of Japan and ECB, that have been trying to get inflation for a long time and haven't been able to do it. But the U.S. seems really committed to it, and I think they're hard to, it's hard to fade them when they want to accomplish something.
Great, thank you. I know you had kind of gold on your list of winners, so we'll take that as somewhat of an indicator for the future as well.
Yeah, I think gold. I do think, and Bitcoin is another story. I got my hair cut like 2 weeks ago. All my barber wanted to do is talk about Bitcoin, which I viewed as a bad, kind of not a great sign. But I think gold has a 5,000-year brand as an alternative to fiat currencies, and Bitcoin has like a 10-year-old brand, and it might go up a lot more from here. But frankly, I'm more comfortable with gold than Bitcoin. But it may be just my own inability to really understand it. But I'm also somewhat skeptical that there won't be a lot more regulatory pressure on crypto, and that could be another discussion for another time. But in any event.
Great, thank you. So let's move on to a sort of a sensitive political topic with all of the political turmoil and this sort of bubbling up of a populist movement and the future of federalism. Are you optimistic that both political parties can work together?
Yeah, Jim. I have to say I'm. And I think probably most of the people on the call probably know. I don't try to really hide my political, views or anything, but I try to be as straight down the middle as I can. I'm hopeful. I'm probably more hopeful than I am optimistic, if that makes sense. Which is to say, I'm hoping it happens, but we'll see. I think. And I'm no old salt. I know there's a lot of people on this call that have been around a lot longer than I have, but I kind of do this for a living and been doing it for a living for 30 years, and I've never seen anything quite like this. And so I do think the incoming administration understands that there are deep divides in the country, and that if they want to get anything done, there's going to have to be more coming together, right? Because I think the incoming Biden administration just does not have the flexibility in terms of Congress. So it may be, whether it's coming from a good place or just a practical place, I don't know. But from as a practical matter, the Biden administration is going to have to compromise some, because you have a thinner majority in the House and you have a 50-50 Senate, and of course Democrats have effective control. But it's not like there was such an enormous blue wave that you could just forget about what the other side thinks. And so, in my opinion, I'm kind of, even just from a pragmatic point of view, I'm hopeful the two sides can work together.
Let's hope so. And I'm going to do one more, and I know we're running short on time. So obviously, you're sitting in Manhattan as we speak, and you've got a presence in Washington. And so, what are your thoughts on sort of the big cities, and in particular, in the future of those cities? And
yeah. Well, Jim, I think everybody on the call might find it amusing. I'm here. We have about a little less than 10,000 square feet of office space in Manhattan, and I'm the only person in the office. We have 45 people in New York City office normally, and I'm the only person here. And then in our Washington office, we have 5 people there, and then there's no one there. Listen, again, I'm hopeful, but I think this is I think Larry Summers called it a hinge moment, meaning, this is different. And I don't think, in much the same way, things didn't quite go back to the way they were after 9/11. I mean, we're still in various forms of undress when we have to go take an airplane flight or something. I think this is going to be very different for central business districts and cities, especially in a place like New York, because it's very costly and difficult to live and work here. And so I know for my company, which is part of Baird and all the thing, but we run it independently. We just taught 50 people that they don't necessarily need to come in every day. And so getting them back here is not going to be so easy. And there are other questions there too, in terms of what the taxes look like and all the other state budgets. And so I still personally, as an old-fashioned person, Wall Street person, I generally tend to think in the service industry, people pay people, and I think there's enormous benefits to being together. And I'm not a particularly huge fan of work from home as the standard way of doing business. But obviously, we're going to have to make adjustments for our colleagues, and there's going to be more of that as part of your daily life. So I guess I'm optimistic, but I do think things are going to change. Things are going to, people are going to have more flexible work hours, and the cities are going to have a tougher time because of that, especially a place like New York, because you quite literally get 4 million people coming in here every day. And, aside from the 8 million people that live in the city, and, a decent portion of them are not going to find it necessary to come in every day. And I think employers are going to give them that flexibility. So there'll be plenty of challenges there.
I think you're right. I think it's safe to say that work habits have been forever altered as a result of this. So we'll see how it all plays out going forward. Boy, I know we could spend the entire afternoon going over all the questions, and we've had a few come into the chat room as we've been talking, but unfortunately we're out of time. Again, the slide deck will be shared with everybody. Jason, thank you very much for your insights, as always, on the mark. Very interesting. And again, like I said, we could spend the entire afternoon with you and be very interested in not think about the Masters at all. So really,
that's a good compliment. It's my privilege to be with you. Thank you, Jim. Thank you, everyone.
Yeah, thank you so much. And Julie, I'm going to hand it back to you. Sorry that we've run a little long, but clearly there's so much going on and so much to cover. So we appreciate the opportunity to be with you.
Oh,
Thank you.
golly. Jim, Jason, and Lewis, thank you so much for sharing your expertise and providing a very informative program. And we hope we can have you back. Like you said, there's so many more questions and real interest in the conversation. So thank you all so very much. And we wish everyone on the call much success and a prosperous 2021. Next week's pre-meeting at 11:45 will be hosted by our fellow Rotarians, Larry Sloan, Jerry Martin, and Sharon LaRue. And we'll also be having our Attorney General, Daniel Cameron, will be our featured speaker. Again, just a round of applause, Jim and Jason. Just know how much we appreciate your time and preparation for today. And since we can't be in the room, I know everyone around is cheering and thanking you for your expertise. So thank you again. And all guests, thank you for being with us. Rotarians, if you'd like to invite folks to our meeting next week, just contact the Rotary office and share their information. So we'll make sure and get them the private Zoom invitation. So again, everyone, thank you for being here. And with that, we're adjourned. Thank you.